Who really controls the US dollar? A power illusion. Who do you think prints the dollar bill you are holding? The US government? The president? Congress? The symbols of democracy and the people's power? If you believe that, then you have been very cleverly deceived. The truth is that the United States Federal Reserve, the Fed, is the entity that decides the fate of the dollar. And ironically, the Fed is neither a government agency nor part of the U.S. government. The Fed is an independent entity, not elected by the people, not accountable to Congress, and not bound by any popular vote. Yet this organization holds supreme power, printing money, adjusting interest rates, and even creating or destroying the entire economy, all by a decision made behind closed doors. The birth of the Fed, a dark power conspiracy. Let's go back to the early 20th century, a time when America was struggling with banking crises, peaking in 1907 when a panic nearly collapsed the financial system. In that chaotic context, the financial elite, the banking tycoons, realized that we don't just need a mechanism to stabilize the market, we need a tool to control it, but it must be in the shadows, away from the public eye. Then, in 1910, a strange but little-known event took place. A group of the most powerful people in America, not legislators, not elected representatives, but representatives of financial dynasties like J.P. Morgan, Rockefeller, Rothschild, along with some specially connected politicians, secretly boarded a private ship, left the mainland, and headed to Jekyll Island off the coast of Georgia. There, at a luxurious resort, they spent several days plotting a plan to establish a central banking system run by themselves. However, the entire meeting was conducted like an intelligence operation. They used fake names to avoid identification. No one was called by their real name throughout the meeting. No official records were allowed to exist. Why would a meeting supposedly for the public good have to be held in secrecy like a coup plot? The Fed is born on a silent night. 3 years later, on the night of December 23, 1913, when most of Congress had left for Christmas holidays, the Federal Reserve Act was secretly passed, with almost no debate, no media coverage, no public oversight. From that moment, a decision that would change the next century was quietly enacted. The Fed was born, but unlike any government agency, it is not an executive agency like the Treasury Department, nor is it an ordinary private company. Instead, the Fed is a hybrid model between public and private, consisting of 12 regional reserve banks, each bank owned by local private commercial banks. These private banks invest capital into the Fed and receive fixed dividends from the Fed's profits, regardless of whether the economy is booming or in crisis. In other words, private banks both invest in and profit from the national money printing machine. So who really holds the rules of the game? A cruel paradox. The Fed is often described as independent from the government to avoid political interference, but no one asks the reverse. Could the Fed be influenced by the financial elite? The answer is, very likely. Private banks nominate the executives of the regional Fed branches. The Fed is not fully audited by the government, especially the most important part, monetary policy decisions. The public cannot vote for the Fed chair. Major decisions, like raising interest rates, printing trillions of dollars, happen behind closed doors, with no one questioned. An unelected, non-transparent organization controls the currency used by the entire world. If real power is the ability to determine the fate of millions without asking permission, then the Fed is one of the most powerful organizations on the planet. How the Fed creates money. The illusory game of currency from debt. We grow up believing that money must be created from labor, from real value. But at the deepest level of the modern financial system, money does not come from value. It comes from debt. And the one manipulating this chain reaction, none other than the U.S. Federal Reserve, the Fed. Money from thin air. But debt is very real. Contrary to popular belief, the Fed does not simply turn on a money printing machine and throw money into the market. On paper, U.S. law does not allow the Fed to directly finance the government, but in reality, there is a magic three-party coordination that perfectly solves this. The mechanism works as follows. The U.S. government issues treasury bonds, a form of borrowing money from the public. Commercial banks and large financial institutions buy these bonds through auctions. Then, the Fed buys these bonds back on the open market, paying with newly created money, generated simply by an electronic credit entry in the accounting system. No printing machines, no gold, no production needed. Just adding numbers to the accounting system. Thus, new money is born, from thin air. But the price of this money is a government debt promise, which the people will have to repay through taxes. Money is created from debt, and the people are perpetual debtors. Each time the Fed buys government bonds, new money is created, and conversely, the government carries a debt burden. And who bears that debt? The people. We are never asked for our opinion, yet we must pay interest on money created by an institution we did not elect. This is no longer a monetary game. This is a perpetual profit model, where the public works, pays taxes, and carries debt, while the Fed and financial elites collect interest. The perfect cycle no one wants to stop. This system operates smoothly and suspiciously because all three parties benefit. The government can spend freely without raising taxes or causing political controversy. Banks resell bonds, get investment money or loans, continuing to earn profits. The Fed maintains leverage to regulate the market, stabilize finance, but essentially controls the money flow. The result is more and more money, but no increase in real value. Financial assets balloon, but debt balloons as well. People struggle with inflation and living costs, illusory money, real debt, the inescapable trap. You might ask, the Fed only issues money by buying bonds. What if no one sells? In theory, that could happen. But in reality, almost never. Because the Fed has the power to adjust interest rates, when it needs to inject money, it raises the bond purchase price, making it impossible for banks to refuse. Commercial banks want the Fed to buy. They get cash immediately, reduce the risk of holding long-term bonds, have capital to lend further, cycling profits, so the so-called open market is actually just a cover for a predetermined decision. The ultimate consequence? An economy based on illusion. When money is created from debt, for the system to continue existing, new debt must always exceed old debt. In other words, America cannot and will never fully pay off its public debt. Because if it did, the entire system would collapse. You are not working for money. You are working to pay off a debt you did not create. No matter how much you save, invest, or spend wisely, the money you hold does not reflect real value. It is just an accounting tool built to keep the credit cycle running. The Fed is not just a place that creates money. They are creating an invisible control system where money is a tool, debt is a shackle, and the people are collateral assets of the future. Financial freedom, just a programmed illusion. After World War II, the world accepted the U.S. dollar as the king of currencies because it was pegged to gold. But in 1971, when the U.S. ended the gold standard, the dollar was no longer backed by real value. It relied solely on trust. Trust in military power, diplomacy, and especially the financial power of the Fed. To reinforce this position, the U.S. made a deal with Saudi Arabia. OPEC would only sell oil in USD. Since then, countries wanting to buy oil had to stockpile USD first. And thus, the dollar became the global reserve currency, even without gold backing it. Poor countries owe debts in USD, but cannot print USD. Whenever the Fed raises interest rates, they suffer, default, and their currencies devalue. From Asia in 1997 to Sri Lanka recently, the scenario repeats endlessly. What is financial freedom really? While working people save money, the currency they hold loses value due to inflation. This is no coincidence. It is a default mechanism set by the Fed and central banks. Inflation is an invisible tax. imposed on those who do not understand the system. Schools teach you to work hard, but not how to own assets. They tell you to save, but your savings are continuously eroded. Meanwhile, the rich do not earn money through effort, but through knowledge, assets, and the ability to leverage financial power. Decoding the monetary matrix is the first step to true freedom. If you don't understand the system, you are being exploited by that very system. Financial freedom only begins when you understand where money comes from, know how to shift from consumption to ownership, and think like a money issuer, not a borrower. In a world where money is created from debt, the only person who has a chance at freedom is the one who understands how it works.